A shift takes place in the condition of delivery. When upward momentum abruptly transitions to downward or the opposite direction, indicating a possible trend reversal, this transition offers a chance for market participants looking for higher risk to reward ratio positions. In this clip, we'll break down what a shift in the delivery condition represents, the steps you must follow to implement it accurately on a chart, along with methods to merge this concept with additional smart money ideas to execute premium setups. So if that's something you're keen on, be sure to tap the like button to show your backing and make sure not to button to show your support and be sure not to. It's your first time here. See you after the intro and disclaimer. So, what precisely constitutes a shift in the delivery condition? CISD is a reversal pattern in which the price's momentum shifts direction suddenly. In this case, you can see a distinct upward trend. These three bars signify the latest upward momentum that has surpassed the most recent market structure. This can also be called the latest buy-side delivery. We use the body of the first candle as a reference for the start of this upward move. The structure is distinctly upward, and following a brief correction, we expect the price to keep moving higher. Nevertheless, if the price unexpectedly falls and closes beneath the demand zone, indicating a full shift in upward momentum, this scenario is referred to as a shift in the delivery condition. So, what does this indicate in terms of price movement? Firstly, it suggests that the breakout was, in fact, a false move intended to target liquidity above this market structure point. The buy-side delivery activated the buy-side liquidity that was then followed by a downward move to complete the market cycle. Make a model. A drop beneath the demand zone shows that buyers couldn't sustain their long entries, and sellers have now gained control. This reversal setup indicates a possible downward shift in the market. So, how do we apply this idea to initiate a trade? At this stage, our market outlook has turned bearish, which means we're solely seeking selling opportunities after witnessing a break and close beneath the starting point of the buy-side delivery. We recognize that former support has now become resistance. This shift in market structure gives us a key signal. As the price retraces to this resistance zone, it presents a strong setup to initiate a short position. Because this zone, once a support level, now functions as resistance, the likelihood of the price rejecting this level and continuing lower rises when entering a short position at this stage. We can capitalize on the bearish momentum, providing us with a high-quality trade setup and an attractive risk-to-reward ratio. Patience is key. Wait for the price to revisit this resistance zone before entering. This approach boosts the chances of capturing a significant downward move while minimizing risk. The same concept holds true for the bearish scenario. A CISD happens when the price abruptly changes direction and breaks above the latest sell-side delivery after clearing liquidity beneath a key low. This shows that sellers have lost control and a potential reversal could be near. When the price retraces to the prior supply zone, it provides a premium entry point for a trade. While similar, the change in the state of delivery and change of character have notable distinctions. A change of character occurs when the price breaks through a clear market structure, signaling a shift in the broader trend. Change in the state of delivery, on the other hand, is more focused on a sudden momentum shift to the opposite side and can signal a market structure shift earlier than a change of character. However, it's important to note that not every change in the state of delivery pattern you see on the chart will lead to a successful trade, especially if it occurs in the middle of nowhere with no clear structure or context. To trade CISD effectively, it must align with other market factors and conditions. Through backtesting, we have realized that CISD patterns are most effective when accompanied by specific conditions to ensure a valid CISD, and to enter a high-quality trade certain rules need to be followed. So let's discuss the key conditions that enhance the reliability of a CISD pattern. Rule 1. A rejection from a key level on the higher time frame. As noted earlier, the CISD is a reversal-based price action pattern, and it proves most effective when it takes place after the price interacts with a significant zone on a higher time frame. Key levels on time frames like the 4-hour, daily, or weekly can strongly impact price behavior. When the price hits these zones and a CISD develops, it suggests a likely reversal at a pivotal point, enhancing the pattern's credibility. Lacking this higher time frame confluence, the CISD may emerge in an area where a substantial shift is unlikely, lowering the chances of a successful trade. Rule 2. Clearing a liquidity pool. A strong CISD setup typically follows a liquidity grab from one side of the market. Liquidity pools tend to build up near clear equal highs and lows, where traders commonly position their stop losses. When price breaches these levels, it activates those stops, taps into liquidity, and sets the stage for a potential reversal. Once this liquidity is cleared, the price often reacts sharply in the opposite direction, creating favorable conditions for a CISD pattern to appear. This action signals that the market has accumulated sufficient momentum for a reversal, reinforcing the setup's reliability. Rule 3. Confirmation through volume. To validate a CISD setup, it's essential to observe a spike in trading volume during the momentum shift. Elevated volume signals greater participation from market players, reinforcing the strength and credibility of the move. Entering a CISD-based trade without this volume confirmation poses a higher risk, as it may suggest a weak shift lacking institutional support. A rise in volume is often visually represented by fair value gaps, FVGs, which occur due to rapid buying or selling that leaves price imbalances on the chart. These gaps reflect intense market activity and momentum. When a CISD pattern aligns with a fair value gap, it strongly implies that institutional entities are driving the move, enhancing the setup's reliability. A pullback into the FVG can act as an optimal entry, as the market tends to revisit these imbalances before advancing with the new trend. Integrating volume, FVGs, and the CISD concept increases the probability of a high-quality trade while reducing exposure to risk. Rule number 4. Waiting for the pullback to the broken level. After the price breaks through the origin point, it becomes essential to wait for a proper retest. This pullback acts as confirmation that the previous level has officially flipped, turning from support into resistance in a bearish setup, or resistance into support in a bullish setup. Executing your trade during this retest not only improves your risk-to-reward ratio but also increases the probability that the reversal is legitimate. By sticking to these structured rules, ensuring the CISD happens at a higher time frame key level, checking for volume confirmation, and being disciplined enough to wait for the retest, you significantly boost your chances of catching high-quality trade setups with real profit potential. Now that we've broken down the CISD concept and the key rules for applying it effectively, it's time to analyze real chart examples to see how this theory performs in live market conditions. But before we dive into the charts, on this 15-minute chart of EUR/USD, we can clearly identify a bearish market structure. The price recently broke below a significant support level, one that had held multiple times in the past. Zooming into the price action, we notice that this break was fueled by strong bearish momentum, highlighted by the formation of a fair value gap, FVG. This indicates aggressive selling pressure and confirms that sellers had momentarily taken control of the market. From a smart money perspective, a pullback to this broken support, which now acts as resistance, would typically be seen as a prime shorting opportunity. However, what followed defied expectations. A strong bullish push, supported by the formation of new fair value gaps, aggressively broke back above the previous resistance zone. This sudden flip in momentum represents a change in the state of delivery, CISD, suggesting a potential reversal. Moreover, the previous break below the support level now appears to have been a liquidity grab, engineered to sweep stop losses sitting beneath the equal lows. So, how do we approach this setup now? According to our trade plan, we identify the opening price of the candle that initiated the bearish leg, the original point of order flow, as a key level. If price revisits this zone and shows signs of rejection, we prepare to go long. But before we execute, it's crucial to zoom out to a higher time frame, such as the 4-hour chart. This helps us validate whether the potential reversal aligns with the broader market structure and institutional narrative. Let's move to the 4H chart and analyze the macro context to see if this bullish momentum holds weight within the larger trend. On the 4-hour time frame, we notice that price has reached a significant level. A minor reaction at this key zone from the higher time frame might indicate a potential shift in the overall trend. Moving to the 15-minute chart, this aligns with the upward momentum currently unfolding. The higher time frame analysis supports the bullish move visible on the 15-minute chart. Our projected target from the higher time frame could be the nearby area of market structure positioned just above the present price action. Let's now switch back to the 15-minute chart. Following our trading plan, We can position a buy limit order at a distance equal to the spread size above the origin point, using a 2-to-1 risk-to-reward ratio. The stop loss will be set at a point that offers protection against normal market volatility. This is one way to implement the CISD pattern in combination with multi-timeframe analysis and other price action techniques to execute a high-probability trade. However, even with the most promising trading setup, the market can behave unpredictably. That's why having a strong risk management strategy is essential. It allows you to safeguard your capital while still being positioned to capitalize on profitable setups when the market shifts in your favor. On the 15-minute chart of the Aussie dollar, this zone has repeatedly acted as support. Traders who entered long positions most likely placed their stop losses just beneath this support level, resulting in a concentration of liquidity below it. Now, let's observe the next development. Price breaks beneath the area with strong bearish pressure. The fair value gap that formed during this drop indicates that the market has breached the level, pointing to a move downward. However, price quickly returns to the previous range, forming a new bullish FVG. This setup signals a full transition in delivery from bearish to bullish. It implies that the initial breakout was actually a liquidity grab orchestrated by market makers, targeting stop orders below that critical support. With sell-side liquidity now cleared, smart money is likely shifting to long positions, targeting the buy-side liquidity positioned above. Now that we've spotted the bias, we're looking to go long, but where should we place our buy limit orders? Based on our trading framework, the origin of the most recent bearish move could now function as support and serve as a valid entry for a long setup. In addition, the fair value gap formed during the retracement may also act as a support zone. Regardless of the entry we select, the stop loss should sit below the FVG for safety. Our take profit objective will be the recent swing highs. Let's see how this plays out. This situation is a textbook illustration of how to spot a shift in the state of delivery on the chart, and how it differs from a typical change of character. A change of character takes place when price breaks through a significant market structure, indicating a shift in the overall market trend. This change may unfold gradually or occur suddenly with strong momentum, but the core signal lies in the breach of a key structural level, showing that buyers or sellers are starting to dominate. In contrast, a change in the state of delivery emphasizes a sudden momentum reversal, where price shifts from bearish to bullish or vice versa. Unlike the change of character, which can take time to unfold, the CISD is marked by a sharp directional flip and gets validated when price crosses the origin point of the prior move. Essentially, CISD offers an earlier indication that a potential trend reversal is underway, often before the broader structure confirms it. When CISD is used in conjunction with liquidity principles, such as liquidity grabs and fair value gaps, it strengthens the validity of the setup. For example, when a CISD appears after liquidity has been collected from one side of the market, it's a strong signal that the market is now fueled for a reversal, making the entry point more dependable. This method helps traders enter trades with greater conviction as their entries align with momentum shifts and critical liquidity zones. By grasping both concepts, CISD and CHOCH, and combining them with liquidity-based analysis, you can sharpen your trading plan and increase the probability of catching high-quality setups with more favorable risk-to-reward ratios. Guys, don't forget to backtest this strategy to see how well it performs in different market conditions. If you found this video helpful, drop a like. It really supports us in making more content like this. Thanks for tuning in, and we'll catch you in the next one.